Hello my fellow freedom builders and welcome back to the channel. Today we're going to talk about a strange stock. We're going to talk about the company Autonation, which is a US based auto dealership. And the reason why I call it a strange stock is that the last couple of days it has kept popping up on my different screeners and scans of the market. And I was a bit surprised to find a car dealership a chain in that sector, and actually something that was growing and that was solid here in the middle of a crisis where people allegedly should be in lack of money. So today I'm going to have a look at it. We're going to look at the technical part, the fundamentals, the numbers. We're going to look at why Autonation might be interesting for the future, and I'm also going to look at some of the risks, and at the end of the video I will give you an assessment as to if this is a stock I could consider for my US portfolio. First of all, remember to subscribe to the channel and hit the like button down there below so that you can see videos like this in the future. Now let's go straight to it and have a look at what Autonation actually is. If you are living in the United States, you probably have seen them before somewhere, but here in Europe we have never seen them before. They are not located here, only in the United States, as far as I can tell anyway. But they were founded in 1991, and that is the largest automotive retailer in the United States. They offers vehicle maintenance, they have repair services, some extended service contracts, protection products and so on. They are very diversified. They're not just selling cars, they're selling all of the stuff around the car, and they're also selling insurances, they're selling the financing part, and they have three legs in their business. They have their domestic brands, they have their imports, and they have the luxury part. And as we can see down here, the domestic segment, that is the General Motors cars, the Ford, the Chrysler. There are some imports, which is the Toyota, Honda, Nissan, Hyundai, and so on. And there is the premium luxury, which is selling Mercedes-Benz, BMW, the Lexus division from Toyota, and so on. So that is basically what they do. Now, if we are looking a bit at the numbers, actually this year, if you are looking at the overall market, you would suspect, as I mentioned in the beginning, that the car sales would be going down. And to be fair and honest, their revenue has actually dropped quite a bit actually, but they have been able to actually make more money, and we can see up here in the last earnings per share surprise, that was they were beating the estimates by 291%, and a sales surprise, and that was just from this quarter, by 12%. Now, one of the reasons why there was such big sales and earnings per share surprises is that all analysts had expected the sales to drop. We can see that we have an article here from investing.com. Autonation sales jump as COVID doesn't scare car buyers. All right. So it seems like that even though we can see from the numbers in the United States that we have a record number of people out of work, we have a record number of people not being able to pay off their credit card debt, just the minimum monthly payment. We have a record number of people requesting some sort of food stamps. Simply they don't have enough money for food. In that environment, it seems like people are still buying cars. And of course, one of the reasons why Autonation is strong is that they are not just selling new cars. They also have a lot of second-hand cars, and they have a lot of the repair and maintenance around the car, so that people that might even consider buying a new car but don't have the money, they choose to get their old car fixed, and that is one of the reasons why Autonation is making money. We can also see that JP Morgan, and this is by the July 24th, that was the day after the earnings came out. We can see here on Seeking Alpha that JP Morgan sees auto dealers as attractive, and they single out Autonation. So they actually think that Autonation are very well positioned in the market to be one of the winners. I will get back to some of the risks because they might not be positioned correctly towards the kind of cars people want in the future, but I'll have a look at that. But as you can see here, JP Morgan upgrades Autonation to an overweight rating from neutral, and its view that execution remains strong, blah, 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 down here. Think that the virus part actually ironically have made the sector fundamentally more attractive with a much improved cost structure. And we can see that Autonation have been able really to cut the cost. They have been firing a lot of people. They have been moving a lot of the sales online. I think I saw a number somewhere saying that 45% of their car sales here in the spring has actually been online. And as far as I can tell, Autonation has been very well positioned in this e-commerce space. They have focused a lot on the online part and are very well positioned there. So what's also has happened here in the spring due to the virus and so on is that a lot of small dealerships have been hit. A lot of the dealerships that have even not been liquid enough, they maybe have been a bit too leveraged, over leveraged, been borrowing too much money, and these dealerships have been shutting down. But since Autonation are not very over leveraged and they have an okay liquidity compared to the sector, then they are actually, it looks like they're coming through quite well in this time of crisis. Now, if we look at some of the overall numbers we have here in Stockopedia, let me just make this a bit smaller here. Here we go, so you can see all the numbers. If you have seen the Stockopedia here before, if not, there's a link to it below. But if you can see here, we have the ranks, the quality, the value, the momentum, and the stock rank. And this is a rare stock where we have all of these four numbers above 90. I actually don't recall having seen that lately. So we have the earnings quality 96, we have a value above here, we have the overall stock rank at 99, meaning that it is outperforming 99% of all the stocks in Stockopedia. We have a PE ratio of 9.3, which is actually impressive, and a PEG ratio which is only 0.9. And that is, of course, because that when we take the PE ratio and divide it by the expected future growth, then we actually can see that we have a good solid car dealership here with a PEG ratio of only 0.9, meaning that we are paying a very fair price. And we are getting a 10-11% return on when we have a PE ratio just below 10 here. All right. There's no dividend yield, that is fair enough, and we can see the numbers down here. I do like the price to free cash flow here, and the EV to EBITDA is also fair enough. The operating margins have been dropping a bit, and they're not large, but they never are in car dealerships because you're not making a 50% operating margin on selling a car. That's how that business is structured. But return on capital, return on equity is fair. They have a Petrosky score at 7. They are down in the cautious area here on the Altman C score, but that is partially because again, due to the structure in this sort of businesses, they are very heavy on the liquidity part. They're having a lot of money tied up and often a lot of debt tied up in their storing a lot of cars in their inventory. So that is one of the reasons for that. When we're seeing the earnings per share growth, it has been down in a slump in 16 and 17, but we can see that 18, 19. And right now, trailing 12 month is looking quite well here. We can see that the growth numbers are great. We can also see that they have a free cash flow that is going up nicely. We do like the free cash flow part. They have been cutting a bit down. I'm not sure that this is completely updated, because I know they have been cutting a lot down on their capex here due to the crisis. So I think this is pretty much cut in half, to be honest. But at least the free cash flow, even without that adjustment, is looking very good. They have cash on the books, but the working capital is negative, even though it is getting better. Let's see if we can see the graph here. Yeah, getting close to break even here. And we can see that they are bringing down their net debt, which I also like. Their interest coverage is not great, and the current ratios is also not amazing. But again, that is partially due to their large inventory. All right. So when we're looking at here, the analysts, only 8 brokers here, but a bit above hold. And yes, I think this is what we can take from this. In the Guru Focus, we can see that they have a good profitability rank, a good valuation rank. And when we look at the different valuation ranks here, we can also see that they are quite well positioned toward both the industry and their own history. It looks good. The operating margins, as you can see, versus history, this is versus their own previous numbers. That is all red, meaning that it has been going down, and that is due to the bad results in 2016 and 17. So down here, as you can see, severe signs, operating margins are declining, a good Altman C score here, and then some medium warning signs. We can see again the debt going down a bit. What I don't like here is to see that a lot of the insiders has been selling. When we look at, and this is, just remember, this is back to 2017, so this is over a number of years, but just here in 2020, we can see that only one buy by an insider and then a lot of selling. So that is not an optimal scenario. And we can also see that the gurus are also there. Some are buying, some are selling. But when we're looking at the last transactions here in March and June, we can see that we have a Ray Dalio, a Jim Simmons, a Paul Tudor Jones, and so on that is selling. So both the insiders and the gurus here at Guru Focus have been selling out, and that might not be a very good sign. We can see though that in Guru Focus they're getting 3 stars here, and as you might remember from earlier videos, this star system says that that's a pure statistical, so it doesn't really say anything about the stock itself. But you can see that with 3 stars, you can see that it should be giving you 8.2% per year on average. But then again, we should never invest from that. Here are some of the most well-known valuation methods when valuating a stock. And you can see that as long as they are farther to the right than this dotted line, then they are in good value. So we have a projected free cash flow here, and we have some discounted here, some cash flow as well. All of these models, 3 or 4 models, are actually saying that it's good value. So if you are a value investor, you might want to look at that part. If we're looking at the fast graph that I often look at, we can actually see a scenario where we have the earnings and the normal PE ratio here. That is the line we are seeing coming up here, and the black line is the price. And here we can see the exact same picture as we've seen in the value scenario. We are seeing a stock where, of course, they've had a kind of a couple of slump years here with some drops in earnings, 1% and 4% drop in adjusted earnings. But we can see that they're going up now, and they are estimated to go up as well. They were quite severely hit, as all these sort of companies was in the crisis in the spring, but has been going up nicely. And to be honest, they are at a place right now where if they were to move up, and I'm not saying that they can do that, but if they were to move up to the normalized lines here and the growth line, there are a lot of potential here. Let's just have a look at the forecasting. When we're looking at the forecasts here, we can see that they are estimating 18 and 9% jump in change here in the adjusted earnings. And if we were to get up just somewhere, let's say up here, if they were to move up to the average growth line, we can actually see that that would give us over the next year and a half 45% in annual return. Of course, it could also go a bit worse here, down here 23%. If they are holding the line they are lying on right now, we would see a 12.5% per year, which is decent. If they were to drop further down, we could see a loss. Of course, that is how that is. But but it actually looks quite okay. And if we are looking at the analyst scorecard, we can see that in 16 and 17 they surprised the analysts quite negatively. But we can see that all of the other years from 09 and up until here in 19, they have surprised either by a good number in the plus or a little in the minus here. And then there are the numbers from 2020. I don't think they have updated this as well. And here they surprised very positively, at least for the quarter. So yes, this is the fast graph, and it actually shows us that we are sitting on a potential long-term value stock. I can say right now, I don't see Autonation as a quick swing play of any sort, but I do see some value in here if you want to go for a longer stretch, 3 or 5 years. It actually seems like they are very well positioned towards a growth. They only have a debt to capital ratio at about 0.4, I think it is. And they have planned 20 large dealerships that are, the first of them are getting built right now. So over the next 3 years, they are expanding. If we are looking at their investors' presentations, then if you have followed my last videos on some of these EV hype stocks, like that could be Nikola or Tesla or Blink or some of these, we have seen some flashy, salesy investor materials where you are kind of maybe feeling a bit like they have spent more time and effort on making good graphics than making good cars. Here, on the other hand, I'm sitting here with a feeling like the materials here are made on a old second-hand Xerox copying machine from 1985. It is a bit blurry and it's all black and white, and to be honest, it was kind of a hassle to get some decent information out of this. So they are absolutely not doing anything to please me and make some eye candy here on the investor presentation. But we do get some decent information here. For instance, we can see that, and this is from 2019, these are not the newest numbers, but we can get a feeling of how the business is structured. We can see that around 52% of their revenue is from new cars, new vehicles. Then we have about a quarter of the revenue from used vehicles. Then they have 16.7% from parts and services. There are some from finance and some others. But this is just the revenue. We don't care about the revenue. We like to see the profit. Where does that come from? And as you can see, only 14% of their gross profit is coming from new vehicles. And I actually like that part, because that part tells me that even though the new vehicle sales should drop, it doesn't hit their gross profit so much again. The used vehicles is 10.4%, but actually almost half of their gross profit is coming from parts and services. And I like that, because in these times where people might want to save a bit on the car, they actually they might go out buying parts and some other services from them. And they might, the finance and insurance also making some money here, and there might be a drop in this because a lot, at least, of the finance and insurance are on newer cars. Here you can see, of course, what brands they are. I'll link to all of this below, and you can also see what revenue and profit they are making on the different brands, and you can dive into the. We can see that the other companies' reports, they have been something like 20 or 30 pages in lots of colors and a lot of Photoshop pictures. And I think you get the picture here that this is 116 pages of black and white, and it took me a while to get through that. One thing I just wanted to mention is that we can see the different states, and they are not present in all states, it seems, but we can see the different states and how many stores they have, number of franchises, and where they are getting their revenues. And in this scenario we are in right now, where we are seeing a spike in the cases due to this virus and a further shutdown and so on, I just took a quick glance at what states they were diversified and allocated into. And as you can see here, they have Florida, Texas, and California as their three main states. They have something like 130 something stores here and a lot of franchises in these three states. And right now, Florida, Texas, and California are severely hit by the virus. So that part could actually influence their sales. But then again, a huge percentage come from the online and the service and so on. So I'm not sure how much that will affect. But that is something. And here we have gone into what is called the qualitative fundamental analysis. We're not just looking at numbers, but we are trying to extrapolate the current situations and saying, what are the risks here? What could hit this business? And of course, the virus is one thing, and that is very obvious. Another thing, let me just scroll up here to look at some of the brands here. As you know, I have been doing a lot of videos about these EV companies. That is Tesla, and that is Nikola, and that is, all of these electrical vehicles, hydrogen, compressed natural gas, and so on. And if we're looking at these brands they're dealing with here, there's not a single one of these that has a primary product which is electrical. I know that many of them are coming up with electrical vehicles. I know that Daimler is coming up, and Toyota, they have some hydrogen, and pretty much all of the brands right now have some sort of small segment of their products that are electrical vehicles. But one thing I think here is that right now it is moving quite fast on the EV side. And one thing I would, if I were to be an investor in Autonation, one thing I would really have a look at and keep an eye out for is if they were doing some extra effort to go into this EV space. Because and this is my personal opinion, that up until now, I have had a feeling that the EV space have been hyped. It has been some sort of political correct way to position yourself driving around in a Tesla or whatever you're driving around in. But it seems like there have been a shift in mood right now and in opinion, so that these EVs are really getting into a strong position right now. And if a company like Autonation is not really seizing that, if they're not really moving into that and say, hey, we also want to be very strong in the EV space, then I think they might lose a big chunk of their business to some of the companies that are coming up moving really, really strong right now. But they can easily do that with the brands they have here. It simply just depends on if they are going to focus on it, because right now that is where the focus is. And if they want to draw in all the new buyers, all the young people that are completely hooked on the EV, on the hydrogen, all sorts of alternative fuel sources, then I think that would be a point I would keep an eye out for. All right. So what is the final verdict here? Let's just have a quick look at the charts. Of course, we're going to look at the technicals. And what we are seeing here, let me just show you on the weekly chart. What we are seeing here is that just with my normal strategy, where we are looking at, we want a trend. So we want the RSI to be above 50, and we want to have the comparative relative strength to be above the markets. We can see that we would have been able to have some very good stretches of buys here, where we could have made a ton of money. But except from a very small, tiny time here and here, there would not really have been any good buying spots since 2015-16 here. So we would pretty much have been held out of this stock and put into stocks that were going up faster. And this is one of the reasons why I'm using this sort of technical analysis that I do. Because if you had been buying here in 2014 and holding up until now, you might be in break even, but your money would have been lying dead for 6 years. So right now, we are actually moving into a zone where we are in a green zone, so there is a potential buy. Normally, I don't care too much about such a single top like this. Normally, a stock can easily blow through that. But what concerns me a bit on the technical part is that if you're looking to the left here, and we can actually draw this further, we can see that we have a test of this area here. We have it here, 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 here. We have something like 10 or 15 tests of this area, meaning that there's a lot of volume, a lot of money that has been traded here. And let's say, for instance, that we have had a lot of volume about a year ago, 9-10 months ago here, and we can see this was tested. A lot of people were buying the stock there, and it went down, down, down. And people were desperate, and it started to go up, and they were saying to themselves, oh my, if I could just get the same price as I got up here, then I would definitely be a seller. And that is definitely something that could be the case here. And what I would personally do if I were to buy this, and I'm not sure I'll buy it, but I'll keep an eye on it for you, and I'll let you know what I do in the future. But what I would like to see in a case like this, where there has been so many tests of the same area around the 50-55 here, is that I would see a break up, a drop back, and then some sort of buyer strength again. Because that would tell me that this area had effectively been broken. And of course, all of the other fundamentals should still be there. And I would have a deeper look into the company. But this is what I would like to see technically. Because right now, I'm a bit afraid that this one is being sent down into an area where it has gone down so many times before, and we can see it has often taken a 20, 30, 40% haircut every time it hits this area. So right now, I'm not a buyer of Autonation, but I must admit that after digging a bit into the company, I think there are some good strength in the company, and there could be a future winner, or at least one of the winners, one of the strong parties in this auto sales business in the United States. We must admit that United States is a very strong auto nation. So of course, having 300 and 350 or 400 auto dealerships and be sitting on a lot of the repair, maintenance, insurance, financing of these cars, that is a very strong position. And now that they are well diversified and also have the e-commerce space, so they can actually sell a lot of the cars by people booking them online, that just makes me more certain that this company could see itself as one of the winners in the future. I'm not 100% convinced, but it will be one of the candidates that I will look into maybe once a month or something like that. Just go through the chart, see what the news are and so on. So it might get into my portfolio at one time. But I'll not be buying right now, even though I am quite positive on the stock and the company. I hope that made sense, and that you got some inspiration and a bit of insight into how I think about a stock and what my thought process are in evaluating if a stock should come into my portfolio. That's all for now. Remember to subscribe and like the video. Take care of yourself and your money out there. Bye for now.